Hi everyone. We invest to take care of ourselves and those we care about. And so when the market turns down like it has so far this year, it can be concerning. So this month, let's take a look at the student of the market to see what might be in store, at least based on a historical perspective. So the first is really looking at bonds. And so bonds have been negative so far this year, but if we look historically, those negative periods for bonds tend to be followed by real positive years. And so we'll see if that continues going forward. Keep in mind the best days for stocks tend to closely follow some of the worst days. And so this is looking back at the last 20 years, and 24 of those 25 best days occurred within 1 month of the 25 worst days. And so we can see some of those big upside days after some of those big down days too. This is an interesting one. It's a contrarian perspective. So we have low levels of satisfaction right now at around 21%, at least back in February, the last time that this presentation was updated. Anything under 34% actually indicates that we may have a real positive return in stocks for the next 12 months. This is going back all the way to 1926, and I'd mentioned in the email about the market really having a 100% recovery rate from all of these historical crises. And so you can see there's little blips along the way when some of those crises do occur, but we do have that strong recovery. And in fact, if you caught 89% of those bull and bear market returns, your portfolio did just fine along the way. If we do see a prolonged inverted yield curve, that's not necessarily a negative for stocks and bonds. And so you can see the positive returns that those asset classes can experience even if there is an inverted yield curve, meaning that long-term interest rates pay less interest than short-term interest rates, which is typically backwards from what we normally see. And finally, recessions. And so that's the concern. If the Fed raises interest rates too much, will it push the economy into a recession? And looking back historically, recession doesn't necessarily correlate with negative returns. In fact, we can still have positive returns even in a recession environment. And finally, this one I feel is pretty interesting as well. When we see bond outflows, that's actually another one of those contrarian indicators that can indicate that there's some upside potential in the bond market for the next for the foreseeable future. And so if you do have any questions about your own finances, please reach out. The most important thing here is that your finances today cover your cash flow needs today, as well as grow to cover those needs for yourself and your family in the future. I look forward to talking to you soon. Have a great day. Bye-bye.